The company's financial statements show the most important information about the company. They give a clear picture of the financial affairs of the company, and its performance, which can be compared with the competitors and peers. Following are the three most important financial statements that readers look for. Balance sheet, that describes where the enterprise stands at a specific date. Income statement, which depicts the revenue and expenses for a designated period. And the cash flow statement that depicts the ways cash has changed during a designated period. In this video we will see the viewpoint and the purpose of the three essential readers of financial information being management, investors, and lenders. The company's management is the first and foremost user of the financial statements. The company's management looks at the financial statement from the perspective of liquidity, profitability, cash flows, assets and liabilities, cash balances, fund requirements, debt to be paid, project financing, and various other day-to-day operational activities. Judging a company's operations is largely done with an analysis of the income statement, while resource effectiveness is usually measured by reviewing both the balance sheet and the income statement. Investors are the owners of the company and to whom management is responsible and accountable. They would like to understand and keep updated with the company's financial performance. The key interest to them is the return on the funds they invested, and the disposition of earnings that belong to them, that is, how much is reinvested in the business compared to how much is paid out to them as dividends. They are concerned about the effect of business achievements and future expectations on the market value of their shares, especially in the case of publicly traded stock. Based on the financial statement analysis of performance, they will decide whether they need to keep invested or move out of the company. Lenders and creditors are interested in funding the needs of a successful business and would like to check the ability of the company to pay the debt. Thus, they go through the company's financial statements, consider the possible negative consequences of default and liquidation, the risk involved in recovering the original funds, before providing loans. They look for a margin of safety in the assets held by the company, because the claims of a general creditor rank behind federal tax obligations, accrued wages, and the claims of secured creditors, who lend against a specific asset, such as a building or equipment. Several ratios are used to assess the liquidity of the business, debt exposure, or leverage of the business, and coverage ratios relating to the company's ability to provide debt service from funds generated by ongoing operations.